Pulkit Patni, who's India Industrial Analyst at Goldman Sachs. Pulkit, good morning. Thank you so much for joining in. You know, we heard Vamakshi right now talking about what is being expected from the sector. And there's a divergence in order inflows as well that we have seen. Order inflow is expected to be tepid for ABB India, Siemens, Thermax, while it is expected to be robust for other companies, the likes of BHEL, Hitachi as well will do well. What does that indicate about the underlying capex cycle going forward?
Sure. Thank you for having me. So we had published a report in April where we had highlighted that in light of the whole tariff-related uncertainty, we expect that private sector capex momentum in India will slow down in Q1 FY25 and things to recover after clarity emerges. Now, what we've seen and what we've flagged in a recent publication is that this seems to have played out. Power sector, which spans across renewables, transmission, distribution, is where award activity has been robust in Q1. Conventional power has been relatively soft because FY25 was very strong. And government-driven infrastructure ordering has been modest in Q1 as well. New manufacturing-related capex is expected to be soft as well. But as I highlighted, power and related infrastructure is going to be strong, and we expect that momentum to continue.
Pulkit, hi, Rima here. What about the outlook on exports? Considering the geopolitical uncertainty that's reigning currently, we're still navigating a deal with the US. Which companies would be impacted and what could be the extent of the impact? And would that be a bit of a problem?
Sure. In Q1, we've actually seen exports get a push as companies wanted to front load their export orders ahead of implementation of any tariff. And hence, we expect industrial companies to report pretty strong export growth in Q1. Part of it could just be front-loading from the second quarter. Based on the companies that have reported so far, if you look at the cable companies, both of which have reported, they've actually reported very strong numbers on export. And that is a reflection of what we've seen in terms of front-loading of the capex, of the export capex in the quarter.
Pulkit, good morning. Thank you for joining in. You know, a lot of these capital goods companies have run up significantly over the last 8 to 12 months. And be it across sectors, be it the likes of Siemens or be it the likes of the railway names, does the valuation surge mean that the margin for error this time around is almost zero, if you could call it that, and very little disappointment on either front could maybe trigger a valuation derating in any of these stocks?
Valuation did correct in the earlier part of the quarter, and obviously recently stocks have run up with valuations again looking towards the expensive side. However, our view is that companies where end market outlooks are strong, as I highlighted, sectors like power, its ancillary, transmission, distribution, we think even if Q1 order inflow is relatively weak, market should use that as an opportunity to actually buy into some of these names, given the fact that power cycles don't tend to be small, in which case the order inflow outlook will pick up going forward. Obviously, this would vary stock by stock, but broadly, we think wherever the fundamentals in terms of the demand cycle is strong, they should be good stocks even at these levels.
So, Pulkit, when we talk about order inflows, they will get better. Is it coming in from any new segment? A lot of new segments are also being introduced by these capital good names. There have been a lot of regulations, be it the emission norms, be it new gensets that these guys have been talking about. How do you look at the entire new diversification strategy taken by these companies, and all of this, would that be margin accretive as well?
Sure. So if you look at the past few years, a large part of the order inflow is actually coming from government infrastructure. While government ordering continues to be decent, we've obviously seen moderation on those high levels. Now, when we talk about specifics of where private sector orders have been coming up, as I highlighted, it is renewable power, it is transmission distribution, data centers, and in many cases, even new energy businesses. We've also seen some strong ordering from the electronic manufacturing sector, but the capex intensity of those sectors tend to be relatively light. And from an old economy perspective, ordering in sectors like cement, etc., continue to be fairly strong. So I think it's pretty broad-based in terms of where orders have come through for these companies.
So Pulkit, which would be your top bets from all the companies that you track at Goldman Sachs? Which are the buy calls? And also give us a picture of the earnings growth expected for the next 2 years and juxtapose that with the valuations.
Sure. So while we don't talk about stocks, we've spoken about the cables and wire sector where we expect strength in terms of the demand outlook both from the domestic and the international markets. And while valuations are broadly expensive, as I highlighted, as long as companies can deliver on their earnings, which in most of these cases is between mid to high teens, we think market should be okay with these rich valuations.
And since we are on that subject of the cables and wire space, Pulkit, competition is one such factor which has been a major trigger in the derating of a sector like paints. You've seen the competitive intensity rising there. A similar trend is emerging, at least in terms of competitive intensity rising in the cables and wire space. But do you see that as a paints moment for this sector, or do you believe that this entire space is big enough to accommodate more players and that the incumbents still have a long runway before the newer entrants eventually start playing catch up?
And this is something we'd also flagged in February this year, that there's a lot of capacity coming in the cables and wire sector. However, a lot of the final outcome on margins will hinge upon how the export market picks up. Let me just remind you, we're talking about a $24 billion export that happens from China and $1 billion of export of cable that happens from India. If we see any shift in that direction, which companies are talking about, then the capacities that are getting added in India could get absorbed. However, if the numbers do not pan out as such, there could be margin compression going forward, because in commodities, typically, when capacities get added, there is margin compression. So this is something we have spoken of in December last year, as well as in February this year. So far, companies that have reported earnings have actually shown robust margins, which means we are probably a little early to have that conversation.
Okay, all right. Take that point. Thank you so much for joining us today and telling us what is expected from the capital goods space and the outlook going forward as well. That's the word coming in from Goldman Sachs. For now, we'll slip into a short break. When we come back, we'll talk about the commodity space with Manisha Gupta.